This is Pete Moore on Halo Academy. We are doing a 2-minute drill. We're going to get a little bit deep for a second on something called GAAP versus cash accounting. Now, as you've watched the other ones, you've seen that we got down to our revenue, expenses, operating profit, and EBITDA, okay? Now, there's two ways that you can actually do that. One is through generally accepted accounting principles, or GAAP, or we can do it just based on total cash, okay? Most businesses run on total cash. So if I just took in $500 for 10 personal training sessions and they are paid up front, I can either take that $500 and I can actually put it on my revenue if I'm doing cash accounting. But if I'm doing GAAP accounting, what GAAP accounting is trying to do is match everything that's happening while it's actually happening. So I'm going to take those $500 if I'm doing GAAP accounting and I'm going to defer that. And what that means is if those are consumed over a 5-month period, then I'm going to book $100 in revenue instead of $500 in revenue, because I want to match the revenue with the personal training expense. So I really understand what the cash flow of my business and how my revenue model works, right? If I take in $500 on personal training and then I have zero expense because I haven't used any of the sessions, I'm kind of fooling myself that I made $500. In cash accounting, I made the $500, okay? In GAAP accounting, I'm actually matching the revenue with the expenses. Now, if I sell a paid in full membership for $1,000, that $1,000 goes where? Divided by 12 or upfront in cash? So what I want people to do is start to look at what your GAAP accounting is so you can actually match the revenue and the expenses of your company, and also don't sell paid in full memberships. But GAAP versus cash could be material, and your investors are going to ask about it. So now you know it.